Hi there, this is Hugo. A massive travel company just reported record domestic growth and exceptional returns on capital, yet Wall Street is pricing it like the entire digital travel industry is about to be wiped out by AI. Today, we're going to look at the numbers, step away from the panic, and see why the market might be handing us the growth of global travel for free. To understand Booking Holdings, you first have to understand what they actually do. They don't own the hotels, they don't change the sheets, and they don't clean the pools. They simply build the digital infrastructure, the apps and websites that connect travelers with accommodations, flights, and rental cars, and they collect a fee for making the connection. What makes this interesting right now is the sheer pessimism baked into the stock price. The market is terrified that generative AI is going to destroy the traditional travel booking model, combined with some short-term fears about geopolitical conflicts. But if you look past the headlines, this management team is aggressively buying back their own stock at a discount, knowing that the underlying economic engine is getting stronger, not weaker. Let's break down how the cash register actually works. Their primary moneymaker is the merchant model, which now makes up roughly 72% of their bookings. Here, Booking collects the cash directly from you when you plan the trip and pays the hotel later. The rest comes from the traditional agency model, where they just invoice the hotel for a commission, plus some advertising and software revenue from brands like Kayak and OpenTable. This is an extraordinarily wonderful business model. By shifting heavily to the merchant side, they hold on to the cash before the trip even happens, giving them a massive float. And travel isn't a subscription software, but they've manufactured recurring behavior through their Genius loyalty program. Over half of their room nights are booked by high-tier Genius members, meaning their best customers come back automatically. We are looking at an elephant here. This is a $121.62 billion company operating in the consumer cyclical sector, with just under 797.35 million shares outstanding. It's massive but capital light. Every business has risks, and we have to look at the ugly truth first. Imagine you own this whole enterprise. Right now, conflicts in the Middle East are actively reducing room night growth and causing localized cancellations. European regulators recently handed them a massive €476 million antitrust fine. And then there's Google. They just announced agentic travel booking at Google I/O, and their Universal Commerce Protocol is designed to let AI agents handle the entire purchase flow. Let's be honest about the risk. Google doesn't need Booking specifically. They could partner with Expedia, go direct to hotel chains like Marriott and Hilton, or slowly build integrations through their commerce protocol. Over time, AI agents could compress margins and erode market share. This is a real structural threat, not fear-mongering. The question is speed and severity. Here's the counter. Google has been in travel for 15 years with Google Flights and hotel ads. They still use online travel agencies as affiliates because the operations are genuinely complex. Cancellations, modifications, refunds, customer service across 2 million properties in dozens of languages. Google does not want that liability. Large hotel chains like Marriott and Hilton represent only 30% of global rooms. The fragmented long tail takes years to integrate. Yes, margins may compress over time, but at 16 times earnings, the stock already prices in some erosion, and management is buying back billions of their own stock at these levels. That's a signal. Let's figure out how much real cash this business is actually generating using our normalized ledger. We begin with the cash this business actually generated, $9.34 billion in operating cash flow. We subtract $615 million in stock-based compensation because that's a real cost of paying employees. We subtract $366 million for working capital changes. Next, we subtract $561 million in maintenance capital expenditures, using the 5-year average to smooth out the bumps. Finally, for working capital reinvestment, we add back $8.22 million because it's a temporary timing drag, not a permanent cost. After all the real costs, this business put about $7.8 billion in our pocket. When we divide that massive pool of cash by the shares outstanding, we arrive at normalized owner earnings of $9.79 per share. This is the heavy lifting that tells us exactly what the business is producing for us. You want to see what a durable competitive advantage looks like? Look at these capital metrics. Over the last 5 years, their capital expenditures required to run the business have been a microscopic 1.77% of revenue. Because they barely have to reinvest any capital, they achieve an astonishing 72.67% return on invested capital. This is a business with immense pricing power, supported by gross margins sitting at 97.30%. Despite heavy competition from Expedia and Airbnb, their competitive trajectory is stable. They are maintaining a resilient direct booking mix in the mid-60% range, and management points out they are taking market share in the critical U.S. market, achieving accelerating growth in the low teens. And the engine is just getting stronger. Over the last 5 years, revenue has grown at an incredible 31.69% compounded annual rate. At the same time, operating margins have expanded from pandemic lows to a sparkling 34.99% today. Looking at the balance sheet, they hold $16.18 billion in liquid assets against $18.94 billion in total debt, giving us a net cash position of negative $2.76 billion. They carry some debt, but their interest coverage is incredibly comfortable. What makes me sleep incredibly well at night is how management allocates that cash. They act like fanatical owners. Over the last 12 years, they have retired over 40% of outstanding shares. In just the first quarter of 2026, they bought back a record $3.6 billion in stock. They are using market pessimism to shrink the share count. So, applying our 4-pillar test, do we understand it? Yes, it's a remarkably clean digital platform connecting travelers to lodging. Are the economics durable? Yes. As we just saw, returns on capital consistently exceed 70% and gross margins approach 100%. The moat is deep. Is management honest and acting like owners? Yes, they have proven extraordinary discipline by aggressively cannibalizing their own share count instead of chasing bad acquisitions. And is the price attractive? Yes, the market is offering this asset-light giant at a very pedestrian multiple. Let's run the final math. We take our owner earnings of $9.79 per share. Given the high return on capital, global scale, and proven growth, we apply a conservative 20 times multiple. We then subtract the net debt position of $3.46 per share. That gives us an intrinsic value of $192.34 per share. Compare that to the current market price of $160. The market is essentially giving us about a 17% margin of safety. You are effectively getting the historical double-digit compounding growth rate of the travel market for free. My verdict is a clear value opportunity. This is a textbook value opportunity. The market is entirely overreacting to temporary macroeconomic clouds and generalized fears about AI disruption. When you can buy a dominant capital-light business with immense free cash flow at about a 17% discount to a fair 20 times multiple, while management aggressively shrinks the share count, you buy the farm and sleep soundly. As always, this is just my analysis. Please do your own research before making any investment decisions. If you enjoyed looking under the hood of this business with me, please subscribe for more deep value stock analysis. Thanks for watching, and I'll see you in the next one.